Well, geopolitical events have remained in focus for financial markets over the last week and certainly over the weekend after US strikes on Iranian nuclear facilities. But it seems, for the time being at least, that tensions in the Middle East are more of a short-term distraction for most participants as opposed to a longer-running narrative. Certainly, equities on Wall Street, they trod water last week and are pretty much hovering around the flat line as the new trading week gets underway, while both treasuries and the foreign exchange complex are struggling for direction a little bit as well. Looking ahead, geopolitical and trade headlines will, of course, remain in focus this week amid what is, frankly, a relatively barren data docket, not only to round out the month of June in the second quarter, but also the first half of 2025. In any case, there's still plenty for us to discuss on the show this week. So without further ado, let's crack on with things. So plenty going on in the markets at the moment, but before we get to that, I must preface this show with a little bit of a health warning because viewers of a nervous disposition may want to look away now because what you're going to see in a second is absolutely horrifying. There he is, my good friend Ryan Littlestone from Forex Slow Live and Forex Analytics in what can only be described as an absolute abomination of an outfit there.
Oh, that coming from the man who wears Curry's uniform most weeks and sit there in a bland old tablecloth as we've just hit in summer. So no, I'm getting with the program, mate. You know, this tan ain't going to get itself working.
Well, I think we might need to enforce some stricter dress standards on the trade-off going forwards. I mean, by the end of June or by the end of July, if this heatwave carries on, we'll have you in a string vest and a sombrero or something, and our viewer numbers would go down the drain if that happened.
Well, that's more your remit, the old string vest. But yeah, well, I was sort of reminded with watching Westy's show last week, Westy and Blake. Westy, obviously, it's winter over there. He was in his warmest cardigan he could find. So I thought, yeah, well, I might as well show that we're getting a bit of sun over here.
Yeah, he reminded me of Roy Cropper out of Coronation Street, actually, but. So at least as long as one of the Pepperstone research desk maintains some standards, then I think we can just about get by. Anyway, enough about our dress sense, and certainly some terrible dress sense over there. Let's crack on with Topical Thunder. So I'm going to leave the geopolitical shenanigans to Ryan. We can get onto those in a second, because firstly, I want to talk about the FOMC, who remain firmly in wait and see mode. There were frankly no surprises from Chair Powell and his colleagues last week at the June FOMC meeting, with the target range for the Fed funds rate being held steady between 4.25% and 4.5%, and with the policy statement pretty much a carbon copy of that issued after the May meeting. Growth and the labour market still being described as solid, and inflation once again described as somewhat elevated. And at the post-meeting press conference, Chair Powell very much stuck to his script as well, noting that policy remains well positioned to navigate the current environment, and that for the FOMC, there really is no need to be rushing in to further rate cuts, even if the direction of travel does still remain lower when the data backdrop justifies it. Now, those cuts, it's interesting because, of course, the June meeting also saw the FOMC unveil their latest round of economic projections, where they nudged their inflation expectations higher and their growth forecasts lower, at least over the short term, but where the median dot continued to point to 50 basis points worth of cuts being delivered this year. That, though, does not really tell the full story, because when you actually look at the dot plot itself, although the median dot remained unchanged from where it was 3 months ago, there's now 7 members on the 19-member committee who see no cuts at all being delivered this year. You've got 9 who see a couple of cuts and a few others dotted around in the interim. And that huge dispersion speaks to the huge degree of economic uncertainty that is still out there. We don't know how tariffs are going to fully impact the economy, and certainly the pass-through of those tariffs has not yet shown up in various inflation metrics, or at least not shown up in full. So in my mind, a wait-and-see approach still makes a hell of a lot of sense, given that the economy remains solid, it's not really crying out for rate cuts, and given those upside inflation risks that remain. But that wait and see message is clearly not what the man in the White House wants to be hearing at the moment. President Trump again stepping up his attacks on Chair Powell on Friday and over the weekend, musing about whether he needs to reconsider his decision not to fire him, and other cabinet members getting involved as well. Commerce Secretary Howard Lutnick has started to join in with this rabble rousing, which I find slightly amusing because this time last year, Howard Lutnick was saying that the Fed, having delivered a 50 basis point cut, was, I quote here, a big red flag and means the economy must be doing a lot worse than we thought. Now, I am, for one, not going to suggest that Mr. Lutnick may have dramatically changed his tune to sort of suck up to his new boss, but I'll leave that up to you. Nevertheless, to add to that, we've also now got Fed board members in public auditioning for their boss's job. Governor Christopher Waller was on CNBC on Friday, mere minutes after the blackout period ended, saying that the Fed could cut as soon as July and that he sees no reason to wait much longer. Effectively, the translation of that is Mr. Waller standing up and going, "I'll do whatever you want, Donald. Just tell me how low you want me to cut interest rates." It is safe to say, though, that that is certainly not a consensus view. And personally, my base case remains that the Fed will deliver just one cut this year, probably in December. Frankly, no matter how loud Trump shouts, because what he hasn't realized is that the louder that he shouts and the more they call for rate cuts, the harder it is for the Fed to deliver them, even if the data backdrop justifies them. So plenty of noise in Washington, D.C. over the last 4 or 5 days on the monetary front.
Yeah, it seems like a month ago now, that FOMC. But yeah, there's two things I took from that. Firstly, numerically, we've got four more meetings to apparently do 2 cuts. We can forget July because we've got a deadline coming up for all these trade talks. So I doubt they're going to move unless we get some real concrete news at that. And the economy at the moment doesn't justify another cut anyway. So if we discredit July, we've got 3 meetings for 2 cuts. But anyway, Powell pretty much also reiterated what we already knew, is that the dot plot and forecasts are a load of old BS anyway, because they could make a case, he said, for either path, any path in those dots and those forecasts. So who cares what the dots mean? We know the market moves on it, though, but it's not going to count for anything. I'm along your lines. Always at the back of my head, the Fed wants rates lower. They're one of the major central banks who have still got rates above 4%. They don't want rates above 4%. That is going to be the direction of travel, lower. But it's going to need the data to hold up against it. And, take all this trade stuff away. Does the data warrant them cutting? Maybe on the inflation front a little bit. But they want to see sustained move down to this 2% target, not a little bit of floating near it and then maybe bouncing away from it again. So they're not out of the woods yet, not by long chalk.
No, absolutely not. And I think the other thing that I was talking about this last week, actually I might have been talking about it with you, or it might have been the week before, everything's kind of blurring into one at this point. This idea that I think, and it probably will gather a bit of steam, we're going to see, I guess you could call it a kink in the futures curve around next spring. Because what you've got is, at the moment, the Fed resolutely in this wait and see mode, with maybe a small risk that there's a more dovish outturn than participants expect. What you've then got is next May, June, the new chair coming in, who is likely to be much more dovish in nature and looking to accelerate the pace of easing. And also potentially by that point, the full effects of tariffs will have filtered through and disinflationary progress will be starting to be made once more. So I just wonder whether we're going to start to see participants or start to see the curve pricing out cuts prior to Q1 26, but then pricing in a lot more cuts from kind of Q2, Q3 26 onwards effectively.
Yeah, it's going to be an interesting trade, I think, because we're going to get all the nominations well before the end of the year. I think it's September, October. I think they all come in and we may get a decision on who's who. So, yeah, we're going to see a lot of action around that. And I think also, again, we're speaking about this on the Flow Show and in the room this morning. I'm wondering whether we're going to see the Fed maybe turning a little political. If we've got the likes of Waller, throwing his hat in the ring by the comments he's making, are we going to see other Fed members who are going to say things that maybe insinuate that they want the job as well, i.e. stuff that's going to please Trump? So it's going to be a funky old end to the year in the next 3, 4, 5 months. And that's just more uncertainty over what the economy is doing and what the Fed should be doing with rates, let alone what Mr. Trump wants them to do with rates.
Yeah, absolutely. I think you're spot on that one. But I've got to say, if I was on the Fed board at the minute, I'm not sure I'd want the job, to be completely honest with you. I think it's a bit of a hospital pass, to be honest. But we'll see what happens with that one. Anyway, moving on from that, of course, because the main narrative in financial markets, or at least over the weekend, has been a geopolitical.
Yeah, absolutely. And, we're looking at, maybe this is another 5-minute risk episode. First, I want to point out that I'm not making light of the situation. We should always keep sight of the humane impact from this sort of stuff. But here we are again in the midst of another geopolitical situation that's moving markets. Now, obviously, over the weekend, the US stepped into the fight with Iran. They sided with Israel, and we saw them acting, and we've seen risk take a hit early trading yesterday, but it's not been in the usual way. Oil, as you can imagine, did move as you would expect. Looking at Brent, it rallied up over $80. All we've heard since then is the forecast getting ramped up, and everyone's becoming an expert on the Strait of Hormuz and what it means for oil. But even now, we're seeing oil pulling back quite sharply. We're trading right at this minute around the $77 mark. So it's come off quite significantly. And yet again, it's another move where we get that initial impact and then the market goes, oh, okay, what now? And we see a bit of a retrace. So as far as oil's concerned, it's going to remain bullish while we've got this geopolitical stuff overhanging it. And while these attacks keep happening, I'm not expecting any steep pullbacks. If we do get a bit of resolution, then we might see something sharper on the downside. Now, what was a bit of a surprise was really what happened in the yen. Euro yen opened up pretty much down 65 pips or whatever. That looked like it was going the right way. Dollar yen as well. And then it just turned around through Asia. Dollar yen rocketed up through 147 and is holding that now. We're even just at a rejection at the 148 level. So I can understand the dollar side of things because we have seen this buy risk in US dollar on some of these geopolitical movements. But the weakness in the yen broadly is really quite surprising. Yeah, go on, mate.
Sorry, I'm going to very rudely interrupt you there, but I reckon it could be an energy story because Japan's obviously a big energy importer. So I wonder whether that's playing a role.
It could be, but then oil's been rallying up since $60, and the yen hasn't really taken off like this has. But yeah, I'll get to that in a moment because there's other things involved in the yen as well. What the Ministry of Finance have done, the BOJ have done, all that sort of stuff. But going back to the risk
now, haven't I?
Yeah, but we're right off balance now. Let me get the card out. I'll save the cards for later.
Well, your yellow card doesn't work anyway, so.
Well, you might make another, Rick, and I'll go straight to a red, and that'll work. So anyway, I'll get back on my train of thought.
Sorry,
shut up. Yeah, zip it up. The same went for the Swissy. If you look at the usual pairs, dollar Swiss, euro Swiss, not really doing anything, and even gold, which I thought both of that and the Swiss would have been rallying strongly when I sat down today. Haven't. Now, for the Swissy, you only have to look at Swiss versus the yen, and I put that alongside the dollar yen chart to see how that the yen is really driving a lot of the pairs at the moment and the risk trade at the moment. So you can see that influence the yen's having at the moment. And it's not that gold didn't rally. If you look at the chart here, we've got to move up to near that 3,400 level. But again, in Asia, it gave it back pretty quickly. So now we're back down to the 3360s. Not a massive drop, but you would have thought with all this going on, we would see that much higher. So there's been a really different picture as far as risk is concerned today over all this. And, it's got me a little confused, I must admit. But time and time again, we see these risk-off moves that often fade, or can fade just as quickly as they happen. And if there's no big retaliation from Iran, if these Israel-US strikes remain sort of surgical in nature, or even if Iran decides it wants to finally come and negotiate, this might be another short-term risk moment that the market will get over pretty quickly, and then we go back to trading what we were before. Now, I'm not saying people should automatically jump in and fade any of these risk moves at the moment, but if the moves can't hold up or they can't continue, that's a warning, at least not to chase them higher.
Yeah, no, I think you're absolutely spot on that one. And it's one of those where markets are always very cold when it comes to geopolitical matters. We are focused on effectively what we think is going to happen next, as opposed to the actual situation on the ground. And I had a lot of questions last week where it was probably about a fortnight ago now when all of this sort of first started. And markets did react to every headline. Missile strikes launched here, airstrikes here, going the other way, etc. Very quickly, markets become immune to that sort of news because it has been discounted. It's a question of, do things escalate or do things de-escalate? And that's what then has an impact. And I wonder whether there is some... I think the sort of calculus now is that what we've seen over the weekend is another example of escalate to de-escalate. Essentially, as you said, these relatively surgical strikes on key nuclear infrastructure within Iran. I think the rhetoric from the United States has been very interesting, very, very disciplined in terms of the messaging from the Trump administration. No push for regime change, no plans for further strikes, certainly not boots on the ground, very much kind of trying to emphasize that this is limited action that they thought it was necessary to take. And we're certainly not going to justify or discuss the justification for that here, but action that was limited that they thought was needed to be taken and that they can now draw a line under things. And I would not be at all surprised if we see some relatively sort of face-saving retaliation from the Iranian side, perhaps some attacks on US air bases within the region, which will probably be fended off, and then they get back around the negotiating table. I would imagine that's how this is likely to shake out. But of course, the situation remains incredibly fluid, incredibly volatile. And I would agree with you in part. I'm not surprised that the moves we saw at the open have paired, but I am surprised how quickly they have paired. I said in my email this morning to clients, I wouldn't be surprised if we ended the week with stocks in the green and crude in the red. I certainly didn't think that we would end the day with stocks in the green and crude in the red, but it looks like there's a decent chance of that happening now.
Yeah, markets these days, it's like goldfish, they only got 30-second memory and then we're back moving on to other things. So it's just the way of the world at the moment, and our goes make it all go faster.
Indeed, so it would seem. Right, well, moving on from that, let's have a bit of a focus here on the UK, because, of course, we had a busy week in the United Kingdom last week, highlighted, although I use that word very loosely, by the latest Bank of England decision, with the BOE, unsurprisingly, holding bank rates steady at 4.25%, continuing their approach of just burying their head in the sand, frankly, and trying to hope that all of their woes go away of their own accord. The MPC, along with that unchanged rate decision, reiterated their policy guidance, noting not only that policy will still need to remain restrictive for sufficiently long to bear down on the risks of persistent inflation, but also that further cuts will be delivered in a gradual and careful manner. Although it must be said that the MPC's 6-3 vote was a little bit more dovish than consensus expectations, with Deputy Governor Dave Ramsden joining external members Dingra and Taylor in a dovish dissent. Nevertheless, it's got to be said, and I think we've said this before, it does feel like that guidance is on borrowed time. The BOE are another one with rates quite considerably above neutral, and although they don't seem to have realised it just yet, it does look like inflation has peaked, certainly underlying inflation, and it also looks like the economy is increasingly stalling as downside risks continue to mount. In terms of some of the data we had out of the UK last week, headline inflation came in at 3.4% in May, down from the 3.5% we saw in April. The more all-important services metric, though, that came down to 4.7% compared to the 5.4% that we saw in April. So as all of those start of fiscal year index-linked price rises fell out of the data, unsurprisingly, we see the disinflationary trend resuming. Meanwhile, consumers are seemingly starting to tighten their belts a little bit, with retail sales having fallen by almost 3% on a month-on-month basis in May. That did snap a run of 4 straight monthly increases in retail sales here in the UK, although some have explained that away by the fact that purchases were pulled forward into March and April. And as a result, we saw a bit of a payback from that in May. And also on Friday, actually, we had the latest public borrowing figures, which pointed to the deficit standing at £17.7 billion in May on the month, which was better than the OBR's forecasts, miraculously, but having said that, it is still the highest ever May figure when you take the COVID period out of the equation. So no surprises on that one. No prizes on that one for guessing what that means in terms of the budget that's coming down the track in the autumn. Further tax hikes are almost a certainty at this point, as our esteemed Chancellor Rachel Reeves remains stuck in what is an ever deeper doom loop. So we have fiscal policy that is going to be imminently tightened considerably further, monetary policy that is frankly too tight, and a central bank that doesn't want to loosen any more rapidly, and cable trading at 135, which frankly is probably only there due to the continued souring sentiment towards the dollar. I don't think this is in any way, shape or form a reflection of some sort of surge in optimism when it comes to UK PLC.
No, I agree with all that. And we've had the PMIs this morning as well, the flash numbers for June. And while there was an improvement in both services and manufacturing, there were two lines that I picked up from that. One, that employment drops had increased and at a faster pace than last month. And two, prices charged had dropped to a level not seen for 4.5 years. So for the Bank of England, they've seen a drop in inflation from this PMI, and we're seeing the labour market getting worse, which is two of the things that we've seen last week as well, what with the CPI data and with that jobs data that we got as well. Obviously, the ONS, they can't count their fingers on their hand at the moment, so take it with a pinch of salt. But yeah, I don't see any reason why they shouldn't cut in August. Whether they do so or not is another thing as well, and maybe we'll get a couple of 50 basis point calls from one of the doves as well.
Well, I think we will, and I think they're going to end up having to speed up the pace of easing because, to me, it just the BOE are worried about persistent price pressures, and I understand that because, let's be honest, they got it badly wrong and they had their fingers burned in the COVID period, as every central bank did, in underestimating inflation. The problem is, I don't understand how someone, for example, the chief economist, Hugh Pill, can stand up and talk about the courage not to act. That was one of the speeches he gave after the May meeting. He's talking about that and the need to stay on hold when the labour market is weakening at such a rate of knots that it's almost impossible to have persistent price pressures because demand is just evaporating within the UK economy. It's not possible for businesses to pass these costs further along the value chain. And the point you made about the PMIs, that they're not exactly comparable, but HMRC payrolls fell by 109,000 in May. If the PMI, and that was the biggest 1 month fall in 5 years since the pandemic, if the PMI is now saying that the pace of job shedding has further quickened in the month of June, I mean, there's going to be hardly anyone on payrolls left by the time we get to the August meeting at this point.
Well, I wouldn't go so glass half empty. The world still turns over here, and we do like to get more bearish on the UK than sometimes necessitates. But the point, if they'd have cut by 25 pips at the meeting, what difference would it made? It would have just given a little bit of easing through the summer, would have allowed, maybe retails to pick up a bit, mortgage rates coming down a little bit. It just gives the country just a little small injection, and you're still restrictive because you've still got rates at 4%, so you can still keep them up. But I know they've got a mandate, but they sometimes seem to have just a one-track mind with everything. And it's all inflation. And they've never been able to control inflation. They're not going to be able to control inflation this time. Inflation's going to do what it wants to do. But in the meantime, they could have done a little cut, ease things along, maybe got into a pause if need be, or if things get worse, then at least they would have been in front of any problems that are going to pick up. We get another shocking report in next month in the jobs numbers, like you say, another let up in payrolls. Then the market's going to be saying you're behind the curve again, Mr. Bailey, and then the proverbial is going to hit the fan.
Yeah, I fully agree, and it's a signalling thing. Ultimately, change the guidance, lower rates. It's a signal that they are attentive and attuned to the issues that are going on within the economy. And before anyone goes in the comments below, oh, you've said that the Fed should be on hold and the BOE should be cutting aggressively. Yeah, they're two very different economies. The UK has no upside inflation risks and a very fragile labour market. The FOMC in the US, they have a very solid labour market and very substantial upside inflation risks. So the two are dealing with very, very different issues. you want to talk about the euro. So another whole different set of issues across the channel to be grappling.
Exactly, because everyone seems like they're a Europhile at the moment. And one other point to come out of
Is
the
that
last.
why you're wearing that shirt? You've gone all European.
No, it's not European. How's this European?
Well, all continental. You've got another button undone now as well.
The button's always been undone, mate. But if it's too much chest for you, I can do it up. Not a problem.
Well, I'm worried about the YouTube censors getting hold of you at some point.
You can put a smiley face over it. I don't know. Let Kyriakos deal with that problem. One other point I want to note from the last ECB meeting was also the acceptance of this newfound love by the euro from investors. But let's get one thing straight. And if you look at the PMIs today, particularly from France, no one's piling into Europe because the Eurozone or European economies are outperforming the US. There's been a lot of hopium about this defence spending and infrastructure spending, particularly from Germany, but that's a 10-year project. Although we did see a little bit of a tick up in some of their numbers in the PMIs, but they're still in contraction, I should point out. But despite all that, flows are still finding their way into what investors see as an island of stability compared to Trump's US at the moment. Now, last week, we heard that some Australian funds are still diversifying out of US treasuries, which looks to be one of the reasons keeping Aussie dollar afloat, well, until the risk headlines today. But, a lot of that flow will be heading into Europe as well and keeping euro dollar supported. And as we pointed out some time ago, flows like these are not a 5-minute wonder. Big money takes time to reallocate to other countries and investments. And it seems we're still seeing a lot of that. Now, the Guard and all the other ECB bods for now seem happy to let it happen. But I think there will be a time when maybe a rally in the euro hits its limits. If we look at the chart and from a wider perspective, I think there's plenty of upside possible for the euro, especially if Trump does get bogged down in another conflict or other conflicts. But the ECB may start to look to apply the brakes if we're pushing, 120s or above fairly quickly and even heading even higher. Now, my colleague Blake was a dip buy on his trade-off show last week, and I think that's a very valid trade. It's going to take some serious sweet talking to reverse the flows back into the US dollar outside of any risk moves, the likes of which we're seeing today. So I think at some point, the market will place the EU, the Eurozone and US fundamentals in the weighing scale and see which way it tips. But until then, as the saying goes, the trend is your friend, and it's never been more appropriate than now.
Yeah, I think I would agree with you on that. That's certainly the way things seem to be going, and also, of course, for the time being at least, President Lagarde at the ECB seems to have sort of given that the green light with what was arguably a very hawkish 25 basis point cuts earlier in the month, basically saying we are done. We do not want to cut anymore unless our hand is forced. The one thing I would say is, and I have been one who has been sort of selling this narrative around political stability in Europe, but ultimately it's all relative. You could argue that things are politically unstable in the United States, but when you look at things, you have a Republican president who is espousing the views now that he has held for the last 4 decades, and they have a Republican House of Representatives and a Republican majority in the Senate. If you then look at Europe, you've got France with a prime minister who is not even a member of parliament and potentially on path for legislative elections later in the year. In Germany, Friedrich Merz is hardly in a strong position. And in fact, the two main parties in Germany, I think, got their lowest vote share ever in their recent federal election. The Dutch government has just collapsed. Portugal is on the verge of collapse. Spain's Prime Minister Sanchez looks to be on his way out as well. Austria have been having issues. Meloni in Italy, somehow Italy are managing to look stable out of everywhere in Europe, which I think probably speaks volumes, nothing against the Italians, probably speaks volumes about how unstable leadership elsewhere in Europe is. Now, as I said, investors at the moment seem to be taking the view that despite all of those shenanigans, Europe is still more stable than the United States. I think, and going back to your point around weighing up the fundamentals, I think when that calculus changes, if, for example, France goes to an election and it's a complete shambles again, or things get a little bit hairy in Germany, that will then be the reckoning for markets to go, oh, hang on, maybe this stability in Europe that we thought was there actually isn't there, and we've just glossed over all the issues because we don't want to be in the US and we don't want to have to try and second guess what the Trump administration are going to be doing. And maybe that is when we start to see some of those flows reverse. The last thing I would say, whether it be Aussie pension funds, whether it be Hong Kong pension funds, there was some reporting about that. I mean, anyone thinking bunds are safer than treasuries, give your head a wobble, for goodness sake.
Exactly. You don't exactly make the case why I should pick up a bucket and go and fill it with euros at the moment. But, this is what money does. It sees a risk in one area and it decides to get out. It doesn't mean it's all going to Europe, but Europe is the biggest block. And, that does hold some sort of stability, even if the fundamentals don't really match up. But, yeah, I think, this is one of those trades where it's not going to happen overnight, but maybe towards the end of the year, through the summer, if we get trade deals done and all that rhetoric and uncertainty eases and the US economy continues to plod along, we get August, September, the market goes, well, why did we rush out of the US? Because the US economy is still booming along at 2.5%, 3%, or we can get 0%, minus 0% in France or Germany, and that's when we might see the switch back. So, yeah, it's not going to be an overnight trade, but something to look forward, particularly going into next year, I think.
Yeah, I would agree with that. I guess the final point I make on that is, despite all of the political nonsense, the bet is the ECB will hold things together because they simply have to at this point. They'll come up with some acronym to bail everyone out, probably. But yeah, hopefully that one is long in the future. Anyway, let's move on to our plays of the day. Just quick enough putting that cup down so it wasn't quite on camera, mate. Well done. Right, I'm going to be looking at gold this week. I am still generally bullish on risk. Let me preface with that. I still think that the market will rally to fresh highs, even if we seem to be a bit stuck around this 6,000 mark in the S&P at the moment. But having said that, I still see a case to be long of gold at the moment. Geopolitical tensions are clearly elevated, not only in the Middle East, but Russia-Ukraine conflict continuing, China-Taiwan, is that going to heat up at some point? So I think there's plenty of participants still seeking a hedge out there. And of course, the other thing to consider, and this is again something that's been going on for the last 3 or 4 years now, is this continued diversification of FX reserves out of the dollar, and certainly in emerging markets, one of the primary ways in which those reserves are being diversified is by increasing gold holdings, and that's why we've seen the yellow metal shining so much over the last 18 months or so. The short term setup. Look,
that's the red. Wait for the second one. There you go.
We managed to get 33 minutes in. That's quite good going for me, to be honest.
Yeah, you take your name.
Where was I? The short-term setup looks decent enough. We're still north of the 50-day moving average, even though we have paired some of that knee-jerk move higher at the open on Monday morning. And we're also still above the $3,300 an ounce figure as well. In terms of upside targets, you've got the April and mid-June highs around 3,440. And if we can get a closing break of that, which is likely to be a bit of a tough ask given how stiff a resistance it's proved thus far, if we do get a closing break of that, then fresh highs could be on the cards. So I still am long gold for the time being. Ryan, we're venturing into the Treasury market.
Yep, we are. Because given I've pretty much gone into hand sitting mode today with all this geopolitical risk going on, I've got a very clear book except for a longer term trade. I've not really found it easy to pick a trade out that might last longer than the next Trump truth bomb. But I think US 10s is an asset that still offers decent risk reward for trading yield moves somewhere between 4.5% and 4.7%. So that's looking for dips in the price to around the 109, 25, 28 area, which puts the yield roughly around 4.5%. I would potentially look at smaller opening trades with a view to add on some of those extensions we've seen to the 463, 64 area, and even up to the 470s. Now, this is one asset that seems to be out of the risk asset loop and all these headlines, and that remains under a backdrop where the Fed still wants rates lower than where they currently are. So if you're looking for something maybe just to get out the noise of all this geopolitical risk, then US 10s is the place to be, maybe.
Very good. Speaking of truth bombs, I've got a play of the day from President Trump, just released on Truth Social. He says, and I quote, Everyone keep oil prices down. I'm watching. You're playing right into the hands of the enemy. Don't do it. Not quite sure markets work like that, pal, to be completely honest with you. But there we go. Maybe we have a Trump call in the crude market now as well. I don't know.
I'm just checking the price. It's just gone up a little bit. There you go. So
do you want to margin call the White House or shall I?
He's probably trading on leverage as well. So anyway,
I'm sure he is. Yeah, someone else's leverage, I imagine.
Yeah.
Right. Anyway, that does bring us to the end of another show. Thank you very much, as always, for watching. Thank you also to Ryan Littlestone from Forex Flow Live and Forex Analytics for joining me, and to our producer Kyriakos as well for bringing things together as brilliantly as always. Hopefully, you've enjoyed the show. If you have, please do drop a like on the video. Leave a comment as well. Let us know how you're trading the markets, or if there's anything you would like us to discuss this time next week. And that is when we'll be back with another episode of the Trade Off, and hopefully when Ryan will have found himself a much better shirt. In the meantime, and as Ryan goes shopping, I will bid you farewell. Have a very good week ahead. No idea what's going on there. Thanks as always for watching, and goodbye for now.